And welcome to the Aaron Katzman Show. I'm your host, Aaron Katzman. We speak to your life, your money, and your investments. And as always, we're coming to you from the spiritual and soon to be financial capital of the world, Jerusalem, Israel. If you like this content, please hit the like button below if you've not yet done so. Please subscribe to both the YouTube channel and to the podcast. And if you think somebody may actually find this of interest, why don't you go ahead and click the share button as well. So, we're approaching year's end. 2025 is quickly getting to the end of the calendar. Everybody got to change their calendars. Okay, that's what we're going to talk about today. Changing your calendars. No. What do you do after another strong year in the market? Okay. As we approach the end of another strong year in global stock markets, many clients are a bit nervous about what the future has in store for their investments. I was just reading something in the New York Times where the person is like, oh my God, the AI bubble is going to burst. What do we do? Clients are calling me, markets are high. What do we do? So certainly people are nervous. It's interesting that after they make a little bit of money in the markets, all of a sudden they get nervous. When things are and when things are dropping, they also tend to get nervous. So they want to know what the future has in store for their investments. I've been getting lots of calls from clients asking if maybe they should actually go ahead and sell and book profits. After all, they read that the market's going to crash, which means, you can find all those websites. We all know where they are. We all get those emails, right? The market's going to crash. What do you do? What do you do? So I guess if it appears somewhere online, it's got to be true, right? Got to be true. Anyway, when we discuss the pros and cons of such a decision, i.e., selling and booking profits, you've got to first of all realize that there could be potential capital gains to pay, right? You might have to pay tax if you realize a gain, meaning if you buy shares in a stock, let's just say at, your investment was $5,000 and you sell it for $7,000, you've got to pay tax on that $2,000 gain. Usually when I then mention to people they may have to pay tax, I get, forget it. I don't want to pay tax, okay? I understand that, right? I fully agree with that sentiment, but sometimes the fact that you have to pay tax is actually a good sign, right? It means that you actually made substantial amounts, or you made money, substantial amounts maybe, or at least you made money, right? It's a good thing. We don't want to do it. We don't want to part with our money, but it means something good happened, i.e. that you actually made money. While I am usually an advocate for holding long-term investments or good investments for the long term, being in it for the long haul, sometimes it does make sense to sell and bank your profit, bank some money. Just because it's been a good year financially doesn't mean that investors should become complacent. The end of the year is a great time to review finances and compare your current situation to your stated goals and needs and check how you're progressing to achieve your goals. I would say now is a great time for strategic planning as well. By planning smartly, you can probably literally save yourself tens of thousands of dollars, which is obviously important. And we all could use another couple $1,000s for tens of thousands of dollars, right? Nobody's going to say, no, I don't want to do it. I'm not going to plan because I don't want to save that money, right? You don't hear that too often, right? So let's go ahead and say that you sell at a profit, okay? And now you've got a big substantial capital gains. As I've mentioned in the past, don't assume that you actually are going to end up having to pay a hefty tax bill. Review your portfolio to see if you have any positions that are currently trading at a loss. I know many investors shudder at the thought of selling something at a loss, right? Psychologically, they can't admit that they actually made a mistake and they bought something which is trading down. But even if you believe that a certain stock will appreciate over the long term, selling off your losers can make you money. How, right? What do you mean? The loss can be used to offset other gains, thus lowering your tax bill, right? If you do it correctly, and I'm not a tax man, got to speak to your accountant, okay? And I urge you to speak about your accountant because this is not tax advice. It can save you tremendous amounts of money. Let's use a real life example. Let's say you've got a gain and you bought, I don't know, one of the high flying stocks this year, Palantir. Okay, you made tons of money in Palantir. And you're also a big yoga fan and you like your yoga pants and you bought stock in Lululemon, which got absolutely whacked this year, got just smacked down. and you're sitting on a huge loss there. What you could actually do, right, is you could use the amount of the loss and offset it against the gain that you had in Palantir, for example. Drastically reducing the taxes that you owe, right? Sounds not so complicated, pretty simple. Again, speak to your accountant about that. But it is a strategy. It's called tax loss selling, tax loss harvesting, very in fashion this time of year. But there's another approach that I'd like to speak about, which is, especially here in Israel, doesn't get nearly as much press. Doesn't get so much press in the U.S. either. It's often used for high net worth individuals, but there are plenty of mass affluent who could use it as well. It's called donor advised funds. They've quickly become one of the most flexible and tax efficient vehicles for those who want to combine financial planning with meaningful impact, i.e., charity, donating money. A donor advised fund allows you to make a charitable contribution today, receive the immediate tax deduction, and then recommend grants to qualified charities over time. For investors facing a high income year, the ability to quote unquote front load charitable contributions to a donor advised fund can provide substantial tax relief while ensuring donations are distributed thoughtfully in future years. Many investors hesitate to sell long held stocks or ETFs, even private businesses, because they don't want to pay capital gains tax. A donor advised fund sort of changes that equation. When you contribute appreciated securities directly into a donor advised fund, you receive a full fair market value tax deduction subject to IRS limits and avoid paying any capital gains tax on that appreciation. That means you've effectively donating with pre-tax dollars, something that's simply not possible when selling assets first and then donating cash, right? So it's really important. Let's say you didn't follow that example. I'm going to give you an example. You purchased stock years ago, I don't know, Coca-Cola for whatever it is, right? For $10,000 years ago. Not a good example, but stock X for $10,000. Today it's worth $50,000, right? If you sell it, you could own tens of thousands of dollars in capital gains taxes. But if you donate the shares to a donor advised fund, not only do you avoid that tax, right? You're not going to have to pay capital gains tax, but the entire amount, that $50,000, which the stock is valued at, goes to charity, right? It's not that, you decide to sell, pay tax, and whatever's left you give to charity. Here you're giving the entire amount of money to charity and you're not paying any tax on it. So it's sort of the best of both worlds. Think about it. Donor advised funds, sort of the new up and coming tax planning strategy. Finally, one of the most overlooked aspects in long-term investing is the need to rebalance your portfolio. Rebalancing is super important for two reasons. First, it keeps your portfolio in line with your long-term goals and needs. And second, it keeps your asset allocation in line with your risk level, which is very, very important. I want to stress that, especially now, right? When markets go up, people have an appetite for risk. It's easy, right? It's easy to make money when everything goes up. Funny thing is that when things start dropping, people take their aggressive risk level and that drops to a bunker mentality, right? They don't want to see risk. They don't want to smell risk. So you have to be honest with yourself. And that's why rebalancing is so important. Let's say a few years ago, you started with an allocation that had 70% in stocks and maybe 30% in bonds. Due to the gains, the strong gains this year in the markets, let's say your asset allocation now is 80% in stocks and down to only 20% in fixed income. Now, what's that mean? It means that your portfolio is, 15%, 14% more aggressive, more growth oriented than you really wanted it to be. So use this time of the year to sit down and reassess your financial situation. If there are changes, take the time now to reallocate your funds to get back to the type of allocation that makes sense for you. Speak to your accountant, speak to your financial advisor. That's what they're there for, and fine-tune your portfolio before year's end. You've been tuning in to the Aaron Katzman Show. We speak to your life, money, and your investments. If you like this content, please hit the like button below. If you've not yet done so, shockingly, I'm surprised, but go ahead. Now is the time to subscribe to both the YouTube channel and to the podcast. And if you think somebody might have found this particular bit of content interesting, why don't you go ahead and share it with them by hitting that share button below. and sending it off to them as well. Thanks so much for tuning in, and we'll speak to you soon.